much of the product price is because of what's happening with Russia, because of the sanctions imposed, and how much of it is because of our limited refining capacity? And again, this just gets back to demand, as every one of these stories we touch on, airline flights. Too much demand, that there's not enough to go around. Same story with refinery capacity. We hear that the refiners are, at least in the United States, are at like 94% capacity. So there's not much more they could do, even if there was additional, oil that was supplied to some of these places.
Well, you have definitely lost U.S. refining capacity. We estimate 1.2 million barrels per day over the last several years. But I think, the important point here is these markets are global. They're not local. And when we look at the global refining capacity that can be utilized, you've essentially taken out some of that Russian refining capacity. And we've also don't have access to some of the key Chinese refining capacity. And by the way, that China point is really critical here, whether it's steel, oil, aluminum, whatever it might be. Over the past 2 decades, we relied on the Chinese growing capacity of, copper smelters, steel mills, refineries, all of that, and they're not really willing to export all this stuff anymore. And then you combine that with the restrictions around Russia, we've lost global refining capacity, and that's what global product prices are reflecting.
Jeff, I've got a really basic question, which I hope is not dumb, because I honestly, I'm trying to figure out what I'm missing here, and that's this. They're talking about this potential price cap mechanism through limiting shipping insurance to cap the price of oil that's being bought in Europe and parts of the world. But at the same time, Europe is saying they're going to stop buying oil as of January 1st. So my confusion is this: why are they talking about price caps when they're going to stop buying them? Is this some sneaky way of maybe saying we're going to need to keep buying it, but we're going to limit the amount of money Vladimir Putin can make? Or would these caps just be for the couple of months left in the year when they're still buying it? I haven't been able to figure that out.
Well, the Americans were the ones who introduced the price caps, and the Europeans were the ones who introduced the sanctions, and they're all in Germany discussing these issues right now. But I think the key point is that price cap will end up creating a loss of supplies. The idea was they put the price caps in there, and that's going to keep supplies healthy. But the bottom line is, as prices go higher, it basically creates a backwards bending supply curve. The higher the price goes, the deeper the price cap is. Then that the Russians don't have the incentive to supply the oil. So this is all viewed strictly from a Western view, as opposed to thinking about how Russia would respond to a price cap. Because ultimately costs rise, and everything from fuel, all of it continue to go up as oil prices go higher. That then restricts the ability or the incentive for the Russians to supply the oil. So you got to look at it from both sides.
So, Jeff, all of that, kind of put it in your pipe and smoke it, and then tell us what this means for oil prices from here through the end of this year. Or more importantly, gasoline prices. I don't think people care about it.
I think, by the way, that distinction, I think, is becoming critical here. The bottom line, the situation across the energy space is incredibly bullish right now. The pullback in prices that we saw last week, we would view that as a buying opportunity. At the core of our bullish view of energy and commodities more broadly is the underinvestment thesis. And that applies more today than it did 2 weeks, 3 weeks ago, because you've just seen an exodus of money from the space, whether if it's in the equities or it's in the commodities, credit, you name it. Investment continues to run from the space at a time it should be coming to this space. Because ultimately, remember, the only way you're solving these problems is through increased investment. So we stick to our guns of, oil prices moving this summer up into that $140 barrel range, given record level cracks, and that's going to be a lot more upside to product prices. Let's remember, gasoline prices treaded water last week in that sell-off, and diesel prices actually went up, which is an indication just how tight these underlying markets. One last point I want to say is, when we think about what's going on in Europe right now, with Nord Stream 1, the supplies of gas going into Europe coming off from Russia, you're going to have to replace that gas, and oil is going to be one of the places you're going to use to replace it with. So, the upside risk on oil and oil products is tremendously high right now.